Leads us to our talk of the tape, whether the storm clouds for stocks are about to pass as earnings season kicks off in earnest next week. Let's ask Tom Lee, Fundstrat's co-founder and head of research. Welcome back. It's good to see you. It's been a while.
Yeah, great. Great to see you, Scott.
Man, I'm going to start calling you Prescient Tom. I hope you don't mind, because this morning at 10:23 in the morning, you said possibly this is the flush. Bottom line, possibility equities reverse into the close. Well, it looks like you called it, Tom. What do you think about this reversal and what it means?
Well, I think if we think about the data for the past week, the stagflation story that gained a lot of prominence in the last 10 weeks, I think has diminished a lot because the jobs report showed good jobs, but soft on wages. We're making progress on the UAW strike. And then, of course, as you know, oil's come off that boil, and these are all pointing to an expansion that's not suffering from an acceleration of inflation. So I think it really helps the idea that, as you said, maybe the flush happened and we can be strong into year end.
Do you really think that this is that moment that that turn is going to begin to happen, Tom?
Part of the tactical view comes from Mark Newton, but I think it was going to be either today or early next week because we had that intraday reading of the put call reach 1.97 only 20 times the last 30 years. It's so rare, but it has almost always signaled an imminent bottom. And then today, as you point out, we had a really hot jobs number, a pretty big sell-off that is reversing in the face of people still saying nothing's gotten better. So I do think the sellers are exhausted and there's a lot of firepower on the sidelines. And if a few things go right, I think we get a big rally.
I know, but the one thing that's not really getting better, and I don't want to ignore it, rates are still high, right? So we're at 488 earlier today on the 10-year, so we're at 477. So we've come off, as you said, the boil, but we've still got a pot that's really simmering rapidly.
That's right. I mean, these are very tight financial conditions. It's probably not a long-term killer if we were at 5 for years, because we know 5% is the average for the 10-year for the last 90 years. But at the moment, that change has been very restrictive. If I was to be half full on this, we know this also means the Fed has less work to do, which means fewer hikes. So in some ways, as long as the market can absorb this change, and it's very restrictive, I mean, it's uncomfortable, I think that's positive. More importantly, as Walter Deemer pointed out, when you have a parabolic rise in rates, it's not going to take the escalator back down. If it does peak, it's going to be a sharp reversal. And then, of course, that's supportive for stocks. Yeah.
You think the Fed's done? Do you think Mary Daly was a pretty big tell yesterday in thinking that San Francisco Fed president, of course, thinking that the move that we've seen in interest rates has caused financial conditions to tighten substantially, in her mind, equal to at least one hike in rates, and that now that is the prevailing thought within the room, that credit conditions have tightened enough, we're restrictive, as you said, we're done?
Yes, I think the Fed feels that they, since September 20th, I think it was clear the market kind of got this new message, well, higher for longer. The market's priced it in. I don't know if the Fed has to keep jawboning it and even threaten further hikes if it's gotten to the place it wants to be. And as you're saying, when you have a Fed member saying it's a hike, another hike on top of that means that we're extra worried.
How about valuations? Are you comfortable where they are and where, just simply relative to rates being high? And, you still believe the economy to some degree is going to slow. It's just hanging in so incredibly resilient. It's stunning. I don't know what else to say.
Yes, I know intuitively investors think PE has to come down because interest rates have gone up. But history shows when the 10-year is between 3.5% and 5.5%, the PE is averaged close to 20 times. Part of it is something that Sheila Bair had written about. It produces capital discipline, and that allows companies to have durable earnings, which means PE should be higher. But also, we're in an environment where nominal growth is higher, which means I also think we're in an EPS surprise environment. That's why PE should go up. It's really 16 times, actually less than that, ex-FANG.